it's a big number. But in terms of who issues them, close to 75% is financial corporations, which means typically banks. Governments themselves are not too much. International organizations and non-financial companies also issue quite a bit. Now, in terms of credit ratings, especially with loose regulations in international bond markets, because people essentially regulation shop when they issue. That's one reason you have Netherlands that's so big. It becomes more important to rely on some sort of information provided by ostensibly independent organizations. That's where credit ratings institutions come in. If a bond was issued to the general public in the US, you have at least SEC to count on to say, at least on paper to count on, to say, okay, there is nothing that should be disclosed that is not disclosed, okay? So other than, real statistical surprises, you're not gonna have a surprise about the company. But in international bond markets, especially when there is regulation shopping, credit rating companies become more important. It's gonna be extremely difficult to issue a bond and get a big demand unless it's privately placed, unless you agree with a credit rating company and they give a rating to that issue. And there are pretty much three big companies in terms of ratings: Moody's, S&P, and Fitch. Moody's and S&P get the lion's share of the market, and Fitch is kind of more specialized in international issues anyway. And it basically shows what their opinion is in terms of credit worthiness. It goes on a scale. Let me see. In terms of S&P, Moody's, S&P, AAA would be the best ever, okay? AA, single A, then triple B, double B, single B. Anything below triple B is considered below investment grade or junk. And by law, for example, mutual funds whose main purpose is not to trade on credit risk cannot invest into junk bonds. Example, suppose you have an actively managed mutual fund that wants to maximize return by investing into equities in general, but they could also go into bonds. That fund in the US legally cannot invest into a double B rated fund, double B rated bond, because that's junk. On the other hand, pension funds cannot invest into anything that is rated below AA. For example, CalPERS is the biggest public pension fund in the United States. Those guys cannot invest into a single A bond. So these actually become important, and especially pension funds are in the hunt for returns because they promise a lot of things to the pensioners. In order to deliver those promises, they're gonna get higher returns. And those actually do make a big difference. Example, AAA spread Fred. This is from it's an index maintained by Bank of America. This was actually originally created by Merrill Lynch, but after the 2008 crisis, Merrill Lynch was sold to Bank of America at $2 per share. At the peak before the crisis, Merrill Lynch was trading at $400. Let me put it that way. Currently, if you own a AAA rated bond, you would earn an interest rate that is about 0.5 percentage point above a comparable treasury. Let's look at single A. Single A is about $1.12. Or let's look at double A. Double A is 67. For example, there is about a 0.5 point difference between single A and double A. One of the primary reasons for that is typically single A is a pretty good credit risk. But pension funds cannot invest into that. That means potential clientele is less. So single A investors actually get a premium based on that. Again, similarly, triple B spread is $1.60. Triple B is one notch below single A. How about double B? No, this is emerging markets. I want the US. 306. Did you see the jump from triple B 160 and double B is 306? So $1.50 difference. Trust me, there isn't too much difference in terms of default risk. I mean, there is a difference, but between a triple B firm and a double B firm, let me see if I can get the default rates. Triple B bond, let's see this table. Come on. Triple B bond has a risk of 1.5% default over 5 years. A double B is 6. But if you actually worked out the math, it doesn't necessarily give justification to 1.5% difference in spreads. Just give you a rough idea. Let me actually do it here. Let's say in both cases, recovery rate is 50%. So let's see. So let's say you get 600 if it defaults, 1,000 if it doesn't. So expected is no. $9.94. So this bond should be trading at let's assume a 1 year rate of 5%. 946. So that should have an implied rate of about 560 On the other hand, if it has 646, 778, it could be that much difference anyway. But it depends on a lot of stuff. These are 5-year default rates. 1-year default rates are actually not that much different. All right. One thing about international ratings, the ratings that an issuer is limited by the ratings of the sovereign country. So if a Turkish corporation issues a bond, the highest rating they can get is sovereign rating for Republic of Turkey. You know, you can't be more creditworthy than the country you reside in. I don't know why that should necessarily be a law. It's not a law, but you know, that's pretty much what we see. You can read all that stuff yourself. All right, that's pretty much all I'm gonna say about bond market. I'll let you guys go early today. Apparently half the class is not here anyway. And we'll talk more about, I'm gonna kind of come back to these a little bit using ETFs, but we'll talk more about international equity markets and how they can be useful in reducing the overall risks of portfolio and increasing diversification. I'll see you guys on Wednesday.